Hi everyone, I am back with another Q&A session to answer your questions. I got a very good response in the last Q&A session and hence I have decided to continue this series. But since there are hundreds of questions, it won't be possible to answer every question. But I have tried to cover as many questions as possible. If I miss your question in this session, I'll try to answer it in the next Q&A session. Just one request, try to keep your questions short. Alright, let's not waste any time and get started. So first question is from Harish and he's asking, hi Sahil, you are saying future is digital, but there's a big competition between tech companies. How will they sustain in the long term with good profit margin? Also tell the tech companies which are having good entry barrier. Right, so as far as competition is concerned, there is certainly a lot of competition between the IT companies in India. But you should look at the global size of the pie. The global IT industry is around $800 billion, which is roughly around 60 lakh crore rupees. And India is the leader in this sector due to availability of talent pool at low cost. And remember that IT sector is only going to grow in the future. There is no industry that doesn't require IT support. In fact, earlier, IT was mainly a support system, but today it is a strategic part of every organization. And every company is now increasing the budget on IT spend. And that is the reason I think that there's a scope for growth for the IT companies, including your large cap, mid cap and small cap companies. So every company would enjoy its piece of pie from the global IT spend, provided it has a strong leadership and the required skill set. And as far as technology is concerned, don't just look at the IT sector. There are a lot of companies that are operating in technology sector with high profitability and good entry barrier. For example, look at CDSL. It is also predominantly a technology-oriented company that deals with demat accounts. And there are only two companies in this sector, CDSL and NSDL. So there is huge entry barrier in this sector. Above all, the demat industry in India is growing quickly because investors have realized the importance of investing in Indian equity. Also, the fixed income instruments are providing very low interest, so that has also resulted in many investors moving their money in the equity market. Then look at CAMS. Again, it has 70% market share in the Indian RTA segment. The next competitor is Karvy, which is less than one-third the size of CAMS in terms of market cap. And again, the mutual fund sector is one of the fastest growing sector in India. Then look at Tanla platform. It is the leader in the Indian CPaaS industry. Apart from Tanla, the only other prominent name in India is Route Mobile. So there are companies that do not have a lot of competition like IT sector. And they also have a reasonably high entry barrier. Then you have Affle India. Again, Affle India is the leading mobile advertising company in India. And remember that it has its own proprietary algorithm for target marketing. It is not like Affle India is using Google ads or Facebook ads for digital marketing. A lot of small digital marketing companies do not have their own proprietary algorithm. So Affle India is like the Google ads of India. Although a very small company but has a bright growth prospect. Of course, there is competition, but there is entry barrier due to its patented technology. Then I would name the newly listed MapMyIndia. It is again a top-class technology-based company with not many listed competitors in India. Of course, there is global competition, but MapMyIndia had a head start of over 25 years and has built a proprietary digital map database for location across India and developed indigenous tools, technologies and systems for data acquisition, processing and dissemination. These are difficult to replicate and have created a high entry barrier in the map and navigation business. Now next question is from Abu Bakr Siddiqui and he's asking, how periodically do we need to reshuffle the portfolio? What stocks to hold, which to sell, how to make that call? For example, Motherson Sumi recently dropped so much but it looks decent on the fundamentals. Right, so as far as reshuffling is concerned, I am not a fan of reshuffling the portfolio periodically. As a long-term fundamental investor, I strongly believe in holding quality stock for long-term wealth creation, at least for the next 5 to 10 years. And if there's a fall in stock that is fundamentally strong, then I use this as an opportunity to buy more. And Motherson Sumi is a very good example. In fact, the entire auto and auto auxiliary sector has struggled in the last 4-5 years due to multiple reasons. Earlier, there was demand side challenges and then there was supply side issue due to semiconductor shortage. And recently, when the situation was improving, Russia-Ukraine war has further worsened the supply side challenges. But these are macro environment. And eventually, when the situation will improve, the fundamentally strong companies will bounce back. So that for me is a buying opportunity in a systematic manner. Although if you are someone who likes to indulge in periodic buying and selling, then I would suggest building two portfolios, a core portfolio and a satellite portfolio. Core portfolio should have stocks that you want to hold for the next 5, 10, 15 years or probably pass on to the next generation. And a satellite portfolio can have stocks that you want to reshuffle. And for reshuffling, you need to keep a track of key events in the economy and identify the hot sectors and companies within them. For example, last year chemical was one of the hot sectors. Then sugar sector jumped quite a lot on news for ethanol blending with petrol. Likewise, you always have 2-3 hot sectors that you can identify and invest in companies within those sectors. So you can invest in hot sectors that are on rise and book profit and reinvest in other hot sectors. Also, you can look at the technical parameters including the charts and all to decide the entry and exit. Although I don't get into the technical parameters and charts. I invest based on fundamentals and macro trends. But even if you do periodic buy and sell based on the hot sectors, I would strongly suggest investing only in quality stocks that are fundamentally strong. Now next question is from Aniket Sawant, and he says 20 years ago what did smart investors look at when they decided to invest in Kotak Mahindra Bank, Titan, Pidilite? What are some common traits that a small cap will go to the moon? So very interesting question. So obviously I'm not the right person to answer this as I didn't invest 20 years back. I wish I was born a little early because early 2000 was the golden period of the Indian economy in terms of growth. But anyways, it's never too late. We still have a huge growth prospect in the next 20-30 years. So 20 years ago, smart investors would have looked at 2-3 key factors that you can look at now to invest in small cap companies for the next 20-30 years. First factor is management quality. For example, look at Tata Group. It is one of the most respected group in the country and is mainly owned by Tata Sons, which is a charitable trust that works for the betterment of the society. So Tata Group has a very strong leadership with focus on adding value to the society. And not only one, but Tata Group has created many multi-baggers including your Titan, TCS, Tata Consumer, Tata Elxsi and so on. In fact, there are still many companies within Tata Group that are still small and can grow big. So management quality is very important parameter. Although it is difficult to gauge the management quality for small companies that do not have a proven track record. But you need to do your research to understand the leadership and their background. The next parameter is growth prospects. 20 years ago, Indian economy was in its nascent stage and mainly run by public companies, and new private players just had entered into the economy. So there was a huge growth opportunity in every sector, right from banking, IT, auto, FMCG, etc. And I believe that we still have this growth opportunity in the next 20 years. The only difference is that the next set of multi-baggers would come from companies that focuses on cutting edge technologies. For example, banking and finance will continue to create multi-baggers, but the company should focus on digital transformation. You can't survive with poor tech in banking sector, especially with the rise of the new age fintech companies that are creating strong competition. Likewise, in auto sector, there is huge runway for companies focused on electric vehicle. Then green energy sector has huge scope of growth. Then technology is one sector that would see humongous growth. The only problem is that 20 years ago, the competition was less. Today, there is a cutthroat competition. So you need to identify companies that are small but still have a good entry barrier. Then one important parameter is valuation. 20 years ago, the access to information and knowledge was very limited. So those who had the knowledge of valuation and fundamentals got the first mover advantage. But today, every information is available on your fingertips. So if you think that, let's say Tata Elxsi has a strong growth potential, it is not just you who knows this. Everyone knows that Tata Elxsi has a bright growth prospect. And due to that, Tata Elxsi commands a premium valuation. So 20 years ago, the Indian companies were not trading at very rich valuation. Today, majority of top companies with bright growth prospects are trading at premium valuation. Although after the recent correction, there is a fall in valuation. So if there is more correction in the market, due to whatever reason, be it Russia-Ukraine war, US Fed interest rate, inflation or whatever, then it would create an opportunity to buy quality stock at good valuation. Because no matter how good a company is, if it is very expensive, then it won't create multi-bagger returns because the stock has already jumped a lot. So yeah, it is a mix of quality, growth and valuation along with a strong competitive advantage. And I'm sure that there are many great companies in the mid-cap and small-cap sector with quality management and bright growth prospect and strong competitive advantage. Yes, valuation can be a question mark because majority of them have already jumped quite a lot in 2021 bull market. Hopefully we'll find them at better valuation in 2022. Now next question is from Sachin Patil and he's asking which tools, resources, sites you use for fundamental and technical analysis. So first of all, I keep a track of the overall economy, the macro factors like your government policies, US Fed movement, inflation, etc. And for that, I simply read news. There are few websites like your Money Control, Economic Times, Mint that I prefer to read. Apart from this, I use Screener.in website. In fact, this website is always open on my laptop. It gives me a great high-level financial understanding of a company. Then I access the annual reports, quarterly reports, investor presentation and analyst meet transcript that I find on the company's website. But this is all after I've gained the knowledge on how to identify fundamentally strong companies. And for that, I've read a lot of books including Intelligent Investor, Psychology of Money, One Up on Wall Street and so on. So if you are someone who is new to the world of stock market and investment in general, then I would strongly suggest reading these financial books. And in case you don't like to read books, then there are audio platforms like your Kuku FM where you can access the book summary of financial books including your Intelligent Investor, Psychology of Money, etc. In fact, not only financial books, you can listen to the book summaries as well as full audio books across genres like motivation, self-help, culture, etc. The best part is the book summaries are available in various regional languages like your Hindi, Marathi, Gujarati, etc. Now next question is from Sudarshan and he's asking need your views on the below 3 sector for next 2 years. I hope that these sectors will not have inflation. Insurance, here he has mentioned HDFC Life and SBI Life, then AMC where he has mentioned HDFC AMC and UTI AMC, and third is platform companies where he has mentioned names like IEX, CAMS, CDSL, Tanla Platform, Apple, Route. So very interesting picks, I must say. Certainly all the 3 sectors that you have mentioned including insurance, AMC and technology platforms are inflation proof sectors. And not only am I optimistic on these sectors for next 2 years, I am optimistic in these sectors for the next 10-20 years. Both insurance and AMC are highly underpenetrated in India as compared to developed nation. So there is a very bright growth prospect for them. And technology platform companies that you mentioned including your IEX, CAMS, CDSL, Tanla Platform, Apple, Route are all highly profitable companies. On top of that, they have a very good growth in earnings and all have negligible debt levels. And that's the recipe for multi-bagger stocks. And yes, they won't be impacted directly with the rising inflation. But valuation can be a question. So rising inflation can result in governments increasing the interest rate that will suck out the liquidity in the market and can impact the share price of companies with high valuation. But that would only create buying opportunity. Now next question is from AV Cool. He says, reading, listening, management call transcript gives much insight of future growth, but not all companies post these on BSE NSE website or their company website. How to get this information? So absolutely reading and listening to management calls and transcript gives a very clear insight about the business of the company and its future growth prospect. By the way, in case if some of you who are not aware, almost all listed companies set up an analyst call after every quarterly result where analysts from various brokerage firms ask questions to the leadership regarding your quarterly performance and the way forward. This gives a lot of insight about the business of the company. And this analyst call can be accessed via either your video, audio or PDF format. You can find it in the investor section of company's website or on the NSE India or BSE India website within corporate information section. So to answer your question, I have personally not come across any company for which I was not able to find the transcript for each quarter, unless it is a very small company. Otherwise, all major companies provide the call transcript on their website. And not only the transcript, you can also access the investor presentation report that also gives a very good picture about the business of the company. Now next question is from Prerak Paruthi, and the question is, I want to know how much should be allocated in direct equity versus mutual fund equity, as I have made a disaster by putting all money directly to equity. My age is 26. I want a good advice related to mutual fund. So this is a very important doubt among new investors and very important to understand the right asset allocation. Now as far as returns are concerned, stock investments are always attractive. I mean, who doesn't like to invest in stocks that can potentially generate multi-bagger returns in short term? Although those stocks would generate multi-bagger return or not is something that you will only know later, but you invest with a hope to generate multi-bagger returns, and that itself is very exciting. Whereas equity mutual funds are not that exciting because you can't generate multi-bagger return in short term from mutual funds. But majority of the investors make a classic mistake here. They only look at the return side. They simply neglect the risk aspect of investment. While stocks can potentially generate multi-bagger returns in no time, they can also fall heavily. So stocks are more volatile. In 2021, when the stock market was in bull run, a lot of young investors got carried away and they invested majority of their money in stocks. In fact, most of them ended up investing in mid-cap and small-cap stocks. And now when there's a correction, those mid-cap and small-cap stocks have corrected heavily. And that's the risk with stocks. On the other side, mutual fund balances your risk versus return. Now I'm not saying that you should not invest in stocks, but it is all about a balanced asset allocation approach. Again, there is no fixed formula for asset allocation, but if you are a new investor who doesn't have much knowledge about stock investment and how to identify right stock, then it is better to have higher allocation in equity mutual funds. Maybe 60 to 70% in equity mutual fund and 30 to 40% in stocks. And within stocks, you also should nicely balance your investment across your large, mid and small cap. And after you gain some experience in the stock market, you can slowly increase allocation in stocks. Within equity mutual fund, I would suggest investing around 50% in index fund with major allocation in Nifty 50 based index. The reason is because in the large cap category, it is getting very difficult for active mutual funds to beat the benchmark, and index funds have a very low expense ratio. And remaining 50% can be invested in active mutual funds, especially the flexi cap category. Because flexi cap allows fund manager to invest the money across your large, mid and small cap sector as per the market situation. Again, there are some good flexi cap funds from Parag Parekh, SBI, Kotak and Axis Fund House. Now next question is from Sridhar. He's asking, some financial advisors and market experts are suggesting to increase SIP amount for the rest of 2022 as they predict markets to have muted behavior, bearish nature with lot of volatility in 2022, where the situation will improve and that markets will have a better rising trend from 2023 onward. Is this a good investment approach to increase SIP amount only for the upcoming 9 months of 2022? So yes, I also believe that 2022 is going to be volatile. In fact, I have mentioned it multiple times in the past. The reason being high inflation and the US Fed to increase interest rate multiple times to control inflation in the US. But if you look at the long-term bigger picture, India's growth story is intact. It means any correction or volatility in 2022 would create a buy opportunity. In fact, there is already a good correction where the majority of stocks are down more than 20-30%. So any further fall would make the stock market even more attractive. And even if the market remains stagnant, it would make it more attractive for long-term investment. So if you are someone who has a lump sum to invest, then you can invest in systematically for the remaining 9 months of 2022 in form of SIP. Now next question is from Ronak Rajpal, and he is asking, do you consider Colgate-Palmolive to be a monopoly company in India? What are its growth prospects? So Colgate-Palmolive has been an undisputed leader in the Indian toothpaste industry with brand Colgate. But over the last few years, there is a growing awareness about the herbal content based toothpaste. In fact, Colgate had close to 50% market share in the Indian toothpaste market in 2018, but it has fallen to 46% now. So there is a fall in Colgate share price due to strong competition from your Dabur, Patanjali, HUL, etc. So as far as monopoly is concerned, Colgate once had a major monopoly, but it is facing stiff competition and it is no more a monopoly. Although Colgate had also forayed into the herbal toothpaste segment, but overall the toothpaste industry in India has a limited market and there's already a stiff competition. And this has been reflected in its market share and revenue growth. So I'm not very confident on Colgate-Palmolive future growth prospect. It will continue to grow, but in a higher single digit or lower double digit. But yes, it is a highly profitable company with negligible debt, and it is also gives a decent dividend. Okay, now let me take this final question from Chandra Mohan. Due to recent change in Parag Parikh FlexiCap fund on not to invest in overseas stocks, can we switch across your Axis Growth Opportunity Fund? So recently, Indian mutual fund that were investing in US stocks had to stop their investment as SEBI has put a limit of $1 billion in overseas investment from Indian mutual fund, and that limit has been breached due to huge investment in the mutual funds that were investing in US stocks. And due to that, popular funds like Parag Parikh FlexiCap fund had stopped accepting new investment. Although now they have again started accepting fresh investment. However, the money from new investors as well as from old investor that is getting invested in the form of SIP would only be deployed in the Indian market. So if you are an investor in Parag Parikh FlexiCap fund, then your new investment would not be invested in the US stock market as SEBI has not revised the limit on overseas investment yet. It is also applicable for all other funds including Axis Growth Opportunity that also invest a portion in US stocks. So basically there is no way to invest in US market via mutual funds as of today until SEBI lifted the restriction, and this limit of $1 billion was set up way back in 2008. So hopefully SEBI will soon revise this limit. But if you want to invest in US stocks now, then you can either invest directly using your new age fintech platforms or via US based ETF. For example, you can invest in Motilal Oswal Nasdaq 100 ETF just like stock. So this is it for this video. I hope you will find the video useful. And if you find it useful, do share it with your friends. I'll see you in the next video. Till then, take care.